5-minute tax guides from your 5-minute tax guy. Short lessons to help you navigate the treacherous, hazardous, and totally unpredictable U.S. federal tax code. Adjustments to income. Adjustments to income are deductions from your gross income and are sometimes referred to as above-the-line deductions. In tax years 2017 and prior, they show up on the front of the Form 1040 at the bottom of the page and are deducted from your gross income to arrive at your adjusted gross income. Under the new Tax Cuts and Jobs Act, adjustments to income are now shown on a separate Schedule 1 entitled Additional Income and Adjustments to Income. Due to time constraints, this video will only cover the most common adjustments to income, and those would be educator expenses, health savings account deduction, deductible part of self-employment tax, self-employment health insurance deduction, IRA deduction, and student loan interest. We will only be listing the highlights of each adjustment and will go into more detail in other videos. Education-related adjustments. Educator expenses. If you are an eligible educator, you can deduct up to $250 of qualified expenses you paid as an adjustment to gross income. If you and your spouse are filing jointly and both of you are eligible educators, the maximum deduction is $500. However, neither spouse can deduct more than $250 of his or her qualified expenses. Student loan interest deduction. Student loan interest is interest you pay during the year on a qualified student loan. It includes both required and voluntary interest payments. Tuition and fees. You may be able to deduct qualified education expenses paid during the year for yourself, your spouse, or your dependent. You cannot claim this deduction if your filing status is married filing separate, or if another person can claim an exemption for you as a dependent on his or her tax return. The qualified expenses must be for higher education. Individual Retirement Arrangement, or IRA. No, not that type of IRA. An individual retirement arrangement, or IRA, is a personal savings plan that gives you tax advantages for setting aside money for your retirement. There are two types of IRAs. Roth IRA. A Roth IRA is similar to a traditional IRA except that the contributions are not deductible and the distributions are generally not taxable. The difference will be briefly discussed in another video. Traditional IRA. A traditional IRA is any IRA that isn't a Roth IRA. Two advantages of traditional IRAs are you may be able to deduct some or all of your contributions to it, depending on your circumstances, and generally amounts in your IRA, including earnings and gains, are not taxable until they are distributed. Deductible part of self-employment tax. A taxpayer who earns self-employment income is subject to paying self-employment tax. Self-employment tax is a tax consisting of Social Security and Medicare taxes primarily for individuals who work for themselves. It is similar to the Social Security and Medicare taxes withheld from the pay of most wage earners. If you must pay self-employment tax, then you will be able to deduct 1/2 of the tax that you pay as an adjustment to income. Self-employed health insurance deduction. Most self-employed taxpayers can deduct health insurance premiums, including age-based premiums for long-term care coverage, if you meet the requirements. The deduction cannot exceed the earned income you collect from your business. For example, if your self-employment activity is a sole proprietorship that generated a tax loss for the year, then you're not allowed to claim the deduction because the business doesn't generate any positive earned income. You can only claim the health insurance premium write-off for months when neither you nor your spouse were eligible to participate in an employer-subsidized health plan. Health savings account deduction. HSAs are tax-deductible savings plans that allow you to save pre-tax dollars for future health care expenses. Pre-tax dollars are subtracted off the top of your pay before withholding is calculated. You must be enrolled in a high-deductible health insurance plan to qualify. You can't be covered by another type of health insurance plan, such as an HMO or a PPO type plan. One of the biggest differences between an HSA and the more widely known flexible spending account, or FSA, is that you don't need to spend all of the money in your account each year, or any of it at all. You are allowed to carry over any unused balance year after year. That's a brief overview of adjustments to income. For a more detailed explanation of any of these adjustments, you can check out my other videos covering each individual topic. Thanks for watching the video. For more great 5-minute tax guides, check out the other videos in my 5-minute tax guide video series. See the list in the description below this video.